Welcome to Property Addicts Australia, your home for everything property investing. Get an insider's view of what really works when building a portfolio. Learn how to avoid the common mistakes, plus get all the tips and tricks from the property investing experts Sana and Mona Ali. Join us to learn from the experts and set yourself up for long-term success in property investing. Proudly powered by propertytwins.com.au.
Welcome to the Property Addicts Australia podcast. We are Sana and Mona Ali, the Property Twins. We are mortgage brokers and buyer's agents helping clients all over Australia build investment property portfolios. In this episode, we have two very special guests with very different views on the federal budget. Tim Wilson, Member of Parliament and Shadow Treasurer, and Diana Mousina, Deputy Chief Economist at AMP. We are cutting through the noise on the negative gearing and CGT changes, what they actually mean, what's misinformation, and what the real-world impact is for everyday investors. We also cover what the budget was trying to achieve and whether it will work, the on-the-ground reality for investors and first home buyers right now, what investors should do to keep building wealth in this new landscape. Welcome to the Property Addicts Australia podcast. We are Sana and Mona Ali, mortgage brokers and buyers agents. And in today's episode, we have two very special guests, Diana Mousina, Deputy Chief Economist at AMP, and Tim Wilson, Member of Parliament and Shadow Treasurer. Today's topic is very important, what the budget really means for property investors. So to kick it off, I'd like to start with Diana. Well, firstly, welcome to the Property Addicts Australia podcast, Tim and Diana.
Thank you for having us.
Thanks for having us.
So over to you, Diana. What's your understanding and rationale for the 12th May budget for Australians generally?
So the background to the budget, I suppose, was one where economic growth has been flat-ish in the past few years. We're basically only able to grow the economy at 2% without generating any unwanted inflationary pressures because we've had this period of 10 years where we've had quite low productivity growth. So the backdrop for the government was challenging from that point of view. We've also got high inflation, a global war, which was increasing energy prices. But the other major challenge was one around, I guess, this intergenerational fairness question, which is, I suppose, how the government was thinking about it, where we are increasingly having a housing market that is becoming more unaffordable, and it didn't seem sustainable to keep going down the path where housing is continuing to get more unaffordable, because for people who are born today or people who are in their early teens, even, it will be increasingly challenging for them to be able to afford a home in a major capital city in Australia. So that's I guess, the backdrop for where the budget was starting from and trying to address some of these issues.
So there have been major changes, right? Like things changed overnight for property investors. So I'd be curious, obviously, Tim, you're very close to the policy and you've been having lots of debates and conversations. Do you agree with that stance that there was some inequity or, future generations not being able to afford their home?
So the starting point is, of course, yes, housing is a challenge. I'm not arguing that for 1 second. But we need to go back and actually look at what the basis of this budget is. The basis of the budget is that the government is spending too much money. The government is spending too much money, so their only solution is either to go into more debt, which they're currently doing and is stoking inflation, or it's to tax more, which is to increase the revenue base. The story that they're making out about it being around intergenerational fairness for housing simply isn't stacked up by the data in their own budget. Their budget acknowledges that there's going to be 35,000 fewer homes built as a consequence of this budget, and the new taxes, as well as increases in rents. That doesn't increase housing affordability. So the government has a problem. They're using this as a narrative because they know that there is challenges. It is important, and I agree that we need to address the importance of intergenerational fairness so young Australians can get ahead. But you don't do that by then just whacking new taxes on those who are aspiring to get ahead. In fact, you actually have a reverse effect of closing the economy and closing the pathways for young Australians to accumulate wealth, to save, to be able to buy their first home. One of the things about the capital gains tax changes is they apply to first home buyers who invested their first home deposit as much as it applies to somebody in their 80s. And so young Australians are being kneecapped by this government and their response.
Thanks for that, Tim. Diana, what's your take of that? Obviously, Tim's view is that it's being dressed as intergenerational equality, but it may not be the case, and the government is spending too much money.
I mean, I think that extra government spending that we've had, or not extra, but quite high spending from the government, both for consumption and investment that we've had, especially in the past 6 years after COVID, which has taken government spending to a record share of the economy, that has contributed to our inflation problem that we're in. And it's kind of hard to argue the other case. So it's been both private spending and public spending that has driven us into this inflation problem. And of course, the private sector can't really grow too much if the public sector is taking some of the resources, things like labour in particular, but also some of the equipment for things like infrastructure building. So the inflation story, I think I agree with Tim's point of view, absolutely there. I suppose from the housing affordability stance, I guess where I'm trying to think about it from was if we didn't make any changes to our current settings in terms of more favourable treatment of housing as an investment, as well as other investments, but Australia does have quite favourable tax treatments from both the capital gains tax discount and negative gearing. If we didn't make any changes to those and we continue to go down the path that we have been, where home price growth has been running well above incomes now for the past few decades, for someone trying to get into the market, say in 30 years' time, they would have had to have spent 24 years saving for a 20% deposit. Even at the moment, a person on average wages has to spend about 11 years trying to save for a 20% deposit. So it's already unaffordable, and we don't want to make it worse. I understand sort of the questions around the aspirational youth, and some of the changes around the capital gains tax changes will increase average taxes for people who are even buying other assets, not just housing, but things like shares. So I sort of understand why some aspirational youth are annoyed at the changes, because on average taxes are going to go up. But maybe as a country, we need to fundamentally understand that if we are going to provide things like an NDIS program, if we're going to be spending more on defence, if we're going to be giving out pretty decent wage increases to people working in the public sector, then we have to fund that somehow. So on average, perhaps taxes do need to go up. If we had, these increases to wealth taxes in this budget, maybe a solution would have been to cut income tax rates, and that would have helped people to feel like maybe there's something in it for me, and helped people to see that there are actually some winners from this budget. I think the problem is that a lot of people feel like there are no winners, or if there are, then I can't see it in the short term. Maybe it's something that's going to help someone in 10 or 20 years' time, but it's not going to help me right here and right now. And a lot of people are feeling quite strained at the moment.
Well, the treasurer in one of the programs on TV this week said that the measures, or as focused on property, are designed to stop people buying their 10th, 12th or 15th property. Now, the challenge is the people who've already done that, they are protected because their rents might go up. They can buy another investment property and that will just offset the rental gain. So they're okay. It's more so people who are actually starting out today, who might want to save up for their future and build up their asset base. They are the ones who would be disadvantaged. Tim, do you have a take of that? Like, what happens with those who actually want to kickstart their property journey right now?
Well, you've touched on a central point, which is it's a complete fraud of an argument. There's grandfathering of existing property investors and the decisions they've made in the past, and they get to keep those benefits while younger Australians are denied the pathway to opportunity. And that's fundamentally the problem. But in addition to that, we also need to be mindful of the impact it's going to have on people who are not property investors. As I said before, the budget papers acknowledge that it will lead to the new taxes will increase rents. And what we've had since the budget is not just the budget papers acknowledge that, but industry acknowledge that there's no evidence that we're going to see an increase in the volume of housing supply for either ownership or for rents. And so what we're likely to see, and we've seen this in Victoria, is a modest reduction in prices. Then you see a reduction in the volume of housing supply that's available on the rental market because confidence is smashed. So what does that do? It pushes up rents for the number of people who are trying to get into just having a home, particularly when we have migration overshooting by about 90,000 a year. And people are looking at it and saying, well, I'm working harder, I'm trying to get ahead, and the cost of my basic rental, which is where most people live before they then go on and buy a home, if they're lucky enough to do so, live. So they're actually being kneecapped at both ends of the market. Long term, though, it also creates other problems. If property becomes an unattractive pathway for people to store their money or to have a pathway to get ahead, it's less likely to build more homes. When you build fewer homes, there's only one thing that ultimately will happen if migration continues at its current rate, which is prices will go up. So you're kneecapping young Australians who are renting. You're then kneecapping young Australians that want to get in a position to be able to save a home. And of course, that's in addition to kneecapping young Australians who are saving for their first home deposit. That's why the narrative or the spin doesn't stack up, because young Australians are getting hit every stage of their journey towards home ownership through higher taxes or higher costs under this budget. And then they're in a weaker position ultimately to go on to buy their first home. There was nothing in this budget which said the example that Diana raised before of 24 years to save your first home deposit, that was somehow going to reduce. In fact, because of this budget, it's likely to extend the time frame for people to buy their first home. So I just don't accept the arguments that are being put forward by the Treasurer.
Well, being mortgage brokers, right? We don't necessarily we're not looking at the data that, economists or the government are looking at, but we are talking to mums and dads day in, day out. And the reality on the ground is 71% of the investors just have one property. According to the ATO, 19% own two properties and less than 1% own more than 6 properties. So the challenge, what we are seeing on the ground, is the borrowing capacity has dropped for those investors down to anywhere 15 to 40%, depending on which lender you're going to. Yeah. What that means is they're adjusting their price brackets, our buyer's agency clients, right, who could have bought a sub 800K property are now targeting first home buyer price brackets, which are 5 to 600K. What that means is they'll be again competing with those first home buyers because they can no longer afford the asset quality they wanted to in the first place. And clients are not only revising their budgets down, but they're looking at cash flow side of things. And therefore, there is a likelihood that people will be putting up their rents, given we have record low vacancy in the capital cities across Australia. And even talking to clients who intended to sell their properties are no longer going to sell, not even to get that capital gains tax benefit they can by mid next year. The reason they won't sell it is because they want to maintain that negative gearing. As we know, negative gearing has a great reverse compounding effect in people being able to pay down their owner-occupied debt over the longer term.
Yep, so people are going to hold on to properties. There's very little good stock coming on the market. So people will be competing for less stock moving forward in our view, in what we are seeing on the ground. Yep. And obviously less stock means pushing up prices. It feels a bit like a gridlock, and if transactions don't happen, state governments don't collect stamp duty, removalists, like everyday people, right? Removalists who move people around don't, get business. Tradies don't really get business. I know we do have less tradies in this country, but it's an impact on all industries, not just property investors. So the whole economy is going to suffer as a result, in our view.
So that takes me to asking Diana, obviously, given all this leads to impact on everything else, like what's your take as an economist on what needs to really happen with all these impacts on people?
So you touch an interesting point that this Australian economy is basically housing and resources. When people say that the economy is held up by those two pillars, I completely agree, because when I do the analysis trying to figure out which parts of the economy is tied to housing, it actually comes out as the single largest sector because of it has this huge multiplier effect, just like you were talking about, all those different groups that are involved. But is that the right framework for the economy in the long term? And my personal view is I don't think so. I don't think that housing it should be as much of a wealth generating investment as it has been in Australia, because my personal view is that it should be more accessible to everyone. You spoke about the 70% of households investors that hold one property, but the remainder of those investors who hold multiple properties actually hold half of the investment stock, and that's on RBA analysis that they looked at recently. So that's a challenge as well. Like, yes, most investors do only hold one property, but for those that hold multiple properties, they actually hold a huge chunk of the stock. And I think some of the changes hope that this changes in the future. In the short term, you are going to see some negative impacts, like you were talking about with people's reduction in borrowing capacity. But I don't think that that's necessarily a bad thing for the future stability of the housing market in Australia and for the future of the economy. But maybe that's more of just a fundamental different view of the purpose of housing. Is it for an investment, or is it for an owner-occupied dwelling and something that should be more seen as like a common good rather than a vehicle to build your wealth in the future? There are many other ways that people can still build their wealth. And I know that young people feel like, well, I'm going to be left behind now here because even if I invest in shares, I'm going to be hit with less concessions for capital gains. I mean, there are sort of ways around this, I think. So the budget's definitely going to give more work to accountants and tax agents and people looking for financial advice. I think that they would be quite happy with some of the changes because people will be looking for more advice. But fundamentally, the question around affordability and trying to get housing on a more sustainable footing is basically to supply more. That's the fundamental problem. I think taxes are sort of part of the reason that we've seen this bid up in prices for the past few decades. But the real problem is that our supply goals have been running further and further away from us really for the past 20 years. We were sort of in a period in the early 2000s where housing supply and demand was more or less balanced. And now it's moved into a situation where housing demand is just continuing to run well above housing supply. So to address this issue, we really need to be able to build more across the country.
So, Tim, how do we solve the supply issue?
It's a good question. And this is where I guess there'd be a difference between myself and Diana, which is if you can't make a buck out of something, people don't invest in it. It's actually just that straightforward. Most of us don't make investments to lose money or for our wealth to be eaten out by inflation. So actually, yes, we need housing that's focused on how people can put a roof over their head. No one's in contest about that. But if you want to build more supply, you need people to be able to make a buck out of it. People can't. And it was already struggling before these changes. It will be even worse after. So you've got one of two choices. You can slow down demand, which includes slowing down migration as a part of that conversation. The other thing is you can increase supply. And of course, the truth is we need to do a mixture of both if we want to improve an outcome. But to increase supply, you need quite a dramatic shift. We have state governments that are competing for skills and labour on these projects through their public projects, particularly in my state of Victoria, which is taking tradies off building new homes and putting them into government jobs to build large public infrastructure projects. That has a downstream impact, not just in fewer people working to build more housing, but it also then increases the cost because they're paid higher wages than they would be if they were just traditionally builders. And that's structurally now built in, particularly because of the influence of the CFMEU. So you then could do things around planning and zoning reform. Most of that's at the state government level, because there are different sort of data analysis that's done, but the Reserve Bank has identified that a significant chunk, well in excess of 20% of building new property, is a consequence of planning and zoning regulation. So at every point, we're kneecapping the pathway for people to actually address the supply problem, but we're continuing to pump more on the demand side. And now the government has come along and said, well, and we're going to remove any financial incentives. So now we want people to invest in housing kind of almost out of the goodness of their own heart. It doesn't make any sense. You need to change a whole mindset, which is focused on growth and economic opportunity, where people have an incentive to invest in building new property. Obviously, then to rent it out to people as is appropriate, as well as building property for people to own. And we need to recognise that housing sits in a hierarchy. Home ownership is ultimately what most people want to achieve for a very simple reason. It's security. It's obviously where they can pay it off and eventually one day live free of the cost of housing, or at least a modest cost around maintenance or body corporate fees. If people can't do that, they then rent on the private market, which is obviously how a lot of people live their lives, a big chunk of the Australians. If they can't do that, then they fall into affordable housing schemes or social housing schemes. Yet most of the focus these days in housing policy is focused on social housing, which is a band-aid to fix a problem that you're not solving up here. We need to fix the problem around home ownership by increasing supply, by making sure there's incentives for people to invest, to build the stock, so that we can house a number of Australians and have the best chance for them to get ahead. And I'm quite unapologetic in saying that, because I think we're band-aiding the problem and actually making the problem worse year on year, because the government actually has an aggressive pro-social housing agenda against aspiring for young Australians to be able to own their own home, because at some point choices need to be made about what you're going to build.
And I wonder what impact it's going to have. I know Diana spoke about what impact it will have on future home buyers, but what impact will it have on people who are looking to buy 1 or 2 properties for their retirement down the track? Who would they rely on then, ultimately? Who will pay for their retirement?
Well, people have a choice in their investment options and what's going to support them in their retirement. Housing is not the only investment vehicle. We know that. And increasingly, as people move further and further towards retirement, they look for more conservative pathways with bonds. But increasingly, we have other products like ETFs and things, which they may not be the traditional model, but they're much more liquid than housing. So I don't think we should be extolling housing as the sole investment vehicle. It's important for some people. Of course, for a lot of people, it is a very core part of their security, but it also has consequences, including the taxes that are applied because of things like land. So people have pathways. The real problem is not the impact it's going to have on investors, though that's significant. The real impact is what it's going to have on renters and first home buyers. And as the budget outlines, it will lead to fewer homes being built while migration continues to overshoot. And concurrently, we have fewer rentals, and the price of rents is going to go up. So it's young Australians who are going to be hurt most, not the property investors.
Well, Grattan Institute analyzed that the rents will increase $2 a week. But my question would be for Diana, like, have you done any analysis if that's accurate?
Well, the estimates from Treasury and as well as Grattan Institute are pretty similar to that. So it's $2 a week increase. I mean, we can sort of use that as a standard for when we're thinking about how much rents are going to go up. Other private groups, housing groups that I've seen have more of an increase, like $9. I mean, that's $9 a week. It's really hard to be accurate about these things because there are a lot of assumptions that go into it. But I think it's fair to say that in the short term, rents from these tax changes may go up by a few dollars a week. But I suppose the hope is that in the long term, it solves some of these problems that we have in the rental market. In the last few years, the reason that rental growth has been so high and vacancy rates have been so low is, again, because of the supply issue. And I think Tim did a really good job outlining what are some of the bigger supply issues that we have in Australia. And also we've had a very high inflation environment in recent years and rate hikes, which doesn't help rents because it tends to push them up. I mean, I'm not saying that rate hikes all the time push up rents, but in some cases, like we've had in recent years, they have. The other point just about super is that the tax changes that were announced don't actually impact super and investing in housing and super. So that's still a really good vehicle for people to build their wealth. You know, the super guarantee is now 12%. I work for a super fund. I'm not trying to say I'm trying to spruik putting more money into super, but it is a really good tool because of the effects of compound interest, which is magical over the very long term. And young people can still access the First Home Super Saver Scheme, which is also allows you to basically use some of your pre-tax income to save for a home deposit. So some of these schemes are still available, and taxes and super have not been touched. So my personal view is that these tax changes will push more people to increase as much investment into their super as they can.
And Tim, what's your analysis on the rent increase? Is it also $2 or $10 a week?
Well, there's been other analysis that's been done by SQM Research before the budget came out that proposed that it could be much higher in the vicinity of 14 to 16%, depending on which market you're in. So I think the government, like a lot of things, is downplaying the nature of the impact of their changes. The certain rents are certainly not going down. We know that. And if you get less investment and less supply, they're only likely to go in another direction. So I think we just need to be sober about that reality. I mean, everything Diana said is right about pathways for growth and future opportunity. But when young Australians who have the least disposable income are required to spend the most on their housing costs while they're trying to save, while they're compelled to contribute 12% of their disposable income into superannuation, at every point they're being kneecapped in their pathway to get ahead and to make choices about how they want to advance their interests. So we have things like the First Home Super Saver Scheme, which has some value. I'm not arguing that, but that doesn't change the fact that another 12% of their income goes off into a super fund locked away until they're 67. I actually think we should be empowering young Australians to get ahead. I think we should be empowering them, one, to be able to, of course, pay rent, because not all of us were lucky enough to live at home. But then the second thing we should be doing is empowering them to actually have the maximum deposit they can to bring home ownership further forward as quickly as possible. And we're not seeing that. Instead, we're seeing the constant tax and undermining of young Australians, and people wonder why the average age of people are buying their first home has gone from about the age of 24 through to the age of 39 and potentially continuing on that spiral. And the more the more government policy kneecaps young Australians, the harder that will be to get ahead. And what's even worse now is we have this horrific proposition where the government is favouring multinationals and corporates to build housing and giving them full tax deductions for doing so, as well as super funds to go off and build housing for young Australians that they own, that they can then rent back to young Australians. But if you dare suggest that young Australians should be able to use their super to buy their first home earlier and cheaper, then apparently this is a heresy against young Australians' financial well-being, which is just a complete fraud. We need young Australians to get ahead. We need them to be empowered, and a policy setting should encourage them to work hard to receive the benefits of that and to be able to invest for their own future stability.
Well, talking about young Australians getting in the housing market, many people, what they would do is they would live at home and pay a board and then buy an investment property and utilize negative gearing to be able to get the foot in the door. That was one step into the property market. And it meant that they were able to obviously afford more than they would otherwise. So it gave them a gateway into property investing. And negative gearing, whilst, it's icing on the cake, right? It's people don't necessarily go out of their way to access negative gearing. It was just like a feature that helped them afford properties. Tim, I'm curious, do you think a middle ground could have been found on this topic and it would have been capped at a dollar figure, like $1 million per person or $2 million? Do you think there could have been something done around that?
Well, of course, there could have been a a middle ground that was found. But there's two problems you've got. The first is that the government didn't take this to an election. And that really is an important point because it goes to the heart of the trust the government then carries in what it's seeking to implement. And that's in tatters. And secondly, yes, of course, you could come up with alternative measures which might cap it in some way, either on properties or dollar value. But we should also remember what negative gearing actually is. And you've highlighted it. It's when you're not paying tax because you're losing money. That's what it is. So when you remove negative gearing, what a shock. The cost of losing money goes up. So what do property investors do? They increase their rents because someone's going to pay, and it's either them or it's their tenant. And that's sort of been lost. People think negative gearing is this kind of magical tax deduction for people who own property, and it's all about them finding a pathway to get ahead. In fact, it's not that. It's actually about saying you're losing money, so we're not going to tax you on losing money. That's it. So I think for a lot of people who've been led down this garden path that it's somehow by removing negative gearing, it's going to have this massive impact on either house prices or rentals. Well, it is going to have an impact probably in the opposite direction. You think that was the experience in the 1980s, 1990s when the Keating government removed it. And in the end, they reintroduced it. It's been the experience in other places like New Zealand. And the only difference between us and most markets is we actually have a way of defining negative gearing, whereas most people just treat it as, the part of people's income streams and offsets, whereas we've given it a term, so it's made it a target. So I think we just need to be really realistic about the impact of these changes.
Will you scrap it?
We've said we're going to scrap the not just the capital gains tax changes and those on trust, but also on negative gearing, because we know full well it will lead to higher rents. The government has admitted that. There's debate about how much that will be. But the experience from years past when it was scrapped is that it will increase the cost of rents and make it harder for young Australians to get ahead.
And Diana, in your view, what would you have liked to have seen in the budget that could have, I know early when we started, you mentioned people are not really happy or not talking about it in a positive light. What could have made it a bit more easier to accept or absorb the changes?
Yeah. I mean, the negative gearing changes, you can still use those for new properties. So I guess that was sort of the offset to not push investors into the established market, but to push them into the new market. About 20% of investor lending at the moment goes to the new market. So most of it actually goes into the established market. And I guess some people will argue, well, that's because the established market is bigger. So there are still pathways to build wealth through negative gearing if you invest in new properties. And that should also help the housing supply issue. So it was good that it wasn't completely scrapped. What I think would have been good to see in the budget was, as I mentioned earlier, I guess more clear winners, which would have made some of these tax changes more palatable for people. I think on average, people agree that housing is unaffordable and that we need to do something about it. But in reality, when we say housing is unaffordable, it means that prices are too high and they need to come down, or for price growth to run below incomes. So the reality is that prices need to fall, and that's now leading to all these concerns that we're going to see a slowing in the economy. But if we if most people understand that that's, a reality in Australia, maybe to make the tax changes more palatable, we should have seen some income tax cuts, because we know that we've had significant bracket creep for taxpayers in recent years. And what bracket creep is basically people's wages moving up into the next income bracket. So it means that they're paying a much higher rate of tax for a small change in their income. And that's occurred because wages growth has been really high in Australia. And we've had a very tight labour market, which has pushed people into exceeding tax brackets. So it would have been good to see some income tax relief, I think, for households. And also, if you have the income tax relief, the capital gains tax changes would have felt a bit better too, because you still pay your marginal rate of tax on capital gains. So if the 47 cent bracket was expanded a bit, for example, you would have caused less people to feel some of the impacts from the capital gains tax changes. So that's something that I would like to see, and hopefully we'll get there in the next few years.
Thanks for sharing that, Diana. And I know you touched on brand new housing. Having been investors ourselves for 16 years, right? When we started we almost bought brand new properties, and we've been quite anti those. Yes, we need to build those, but the problem I see with this is the amount of spruikers that will be coming out in the market trying to sell those properties. And once someone's bought that property, it's secondhand anyway. So when they sell it, they run into the same problem. They have an undervalued property because possibly maybe no one wants to buy it anymore because they don't get the same benefits that the buyer did. So I get it helps, but yeah, I'm still uncertain about it being an investment strategy to buy brand new properties.
And
And
you're
you can
paying.
also use more of the depreciation on new properties when you purchase them. So from a tax point of view, it might actually be more beneficial. I mean, I don't know. I'm not a tax accountant, but
Mona
that's
is.
just
Well, I
easy.
was trained
Oh,
as a
there you
tax
go.
accountant, and I know negative gearing or tax benefits was never a strategy. It was just icing on the cake. In our own journey as well, that's how we treated it. With brand new, as Tim earlier spoke about, tradies commanding higher pays because they're in so much demand, means people will be paying premium prices for these brand new properties, way over compared to established properties. So, well, we don't see value in it, but that's just our view.
But I suppose we do need more housing in Australia. So, yeah.
Tim, what about yourself? I know you touched on a few points on what you would have liked to have seen in the budget, or would you like to just give us a quick snapshot of what we can expect from you and what should be done moving forward?
Well, I think what we want from a federal budget is a pathway to economic growth. Australia's seen the largest decline in living standards of any developed nation in the world. And the only response from the government is shrug their shoulders, add more inflation, and then increase the volume of taxes. That is not a way to build a united country with a sense of confidence and optimism about its future. I think what we need is not just a pathway for growth, but particularly to back in the self-starters of Australia, the small and family businesses and the self-employed who, through their own blood, sweat and tears every day, wake up and try and build an economic opportunity for themselves, but also for other families in the country. Not everybody can be a small business person. I understand that. But those are the people who disproportionately employ more Australians. They disproportionately contribute the most to productivity and improvement of standard of living, and they're most disproportionately likely to be innovative is in building out the future of the Australian economy. And so I think we need to be aligning our tax incentives and our other structural incentives towards encouraging small businesses. Instead, we've seen the reverse, and it's a very clear divide between us and the Labor government now about where we should be building out the future of the Australian economy. Because small business is struggling. We have record small business insolvencies. We need to be rallying around them and backing them in hard. And we've started a campaign, standwithsmall.org. So standwithsmall.org, because we need to not just rally the small business of the country, we need to lead them to a brighter future so they can go on and back in families, communities, and of course, themselves to be part of the success story of our nation.
Thank you for that, Tim. And I suppose I know we've discussed in today's discussion that property is just one path and one vehicle, and there's lots of them. What was going for property was the leverage, right? Being able to borrow, say, 80% of the value of the property, and when you have gains, they are in proportion to what the leverage is. But from our perspective, really, the fundamentals of property haven't changed. Supply is still an issue in Australia. We don't think the markets are going to stop. Yes, it's become a little bit harder. People would still build portfolios. It might just take a little bit longer than it would have until the budget night, I suppose. And yeah, that's for me. And Diana, any final thoughts from you?
Well, I guess just not talking about property or the budget, which I'm a bit sick of talking about after the last few weeks of nonstop commentary. I mean, I think Australia still has a really good long-term position in the global economy. We are a really diverse economy, which is good, because if one sector isn't performing so strongly, then you sort of have offsets from other parts. And the economic malaise of the past few years reflects the very high inflation that we've had and the rate hike. So I understand why people are feeling like they're left behind. But at the same time, household wealth growth on average has been incredibly strong. Household income growth is actually not too bad when you account for all the gains that the average household has had, not just in terms of wages, but also through things like the increase in the super guarantee and through the churn in the labour market, which has meant that actually income growth overall has stepped up, and we've seen a big rise in median wages and also just average wages overall. So there are reasons to be optimistic. I think we really need to solve the productivity challenge, but it's not something that can be solved in the short term. And in housing in particular, actually, there's a big productivity challenge there because it takes about 53% longer to build a home than it did 30 years ago. So that's something that needs to be addressed to help the supply issue. But I think that Australians can still be optimistic for the future. And, we're not going down the path where our economy is going to collapse. I think we still have a really strong economy relative to our peers. We have one of the strongest levels of GDP per capita in the world, and that's something to be proud of and to keep us optimistic, because I feel like there's a lot of doom and gloom out there at the moment.
Well, thank you so much, Tim, Diana. It's been a pleasure having you in Property Addicts Australia podcast. A great conversation. Thanks again for making time for our audience.
Thank you for having me.
Thank you.
That's it for today's episode. We had Tim Wilson, Shadow Treasurer, and Diana Mousina, Deputy Chief Economist at AMP, giving us two very different takes on the budget and what it really means for property investors. If today's episode got you thinking about your own strategy, reach out to us at Property Twins. Don't forget to subscribe, leave us a review. Thanks for listening. Join us next time for another episode of Property Addicts Australia podcast.
Thanks for listening to Property Addicts Australia. For future episodes, click follow. Leaving a review helps others find the podcast. And for more information about how we can help you, visit propertytwins.com.au.